The role of foreign investment in inflating U.S. real estate prices. Foreign investment is reshaping the U.S. real estate market, increasing prices and intensifying competition. As international buyers flock to American properties for stability, better returns, and potential residency perks, their influence on the market becomes increasingly significant. Understanding their motivations reveals crucial insights into the evolving landscape of U.S. commercial real estate. How and why investors from other countries choose to invest in the U.S. should be of interest to every American commercial real estate investor. It is no secret that foreign individuals and companies often compete for the same deals many of us are searching for. Just ask commercial real estate brokers or investors in NYC, the SF Bay Area, and Seattle, among other places. Why is there international interest in U.S. CRE? Like any disparate group of people, international investors have many different motivations for deploying capital in U.S. commercial real estate. The United States is a political and economic haven. Instability in their home country is a primary driver behind the influx of foreign CRE capital into U.S. markets. The unsteady political and economic situations in many countries lead those with the means to seek out opportunities elsewhere as a way to hedge against a whole host of issues related to instability, from government seizure of assets to losses caused by political upheaval, overbearing taxation regimes, and all of the other ways that those with means can suffer economically from a problematic social system. Investors know that when they deploy capital in the U.S., their assets will not be seized without cause, and they will benefit from the stability that has long been the hallmark of the American economic system. The United States offers excellent returns compared to many foreign property markets. Overseas investors often have a different definition of what constitutes a good return, especially when you take into account the possible returns they might see in their home countries. But another way, their hurdles are lower than those a traditional U.S. investor would seek. They don't have to get maximum return from a deal. When they engage in development or look out for existing cash flow deals, they are not necessarily looking for the highest yields. They are looking for a good yield, but many times they are not looking for the same yields that domestic investors are set on. This is one of the reasons you see many foreign groups outbid domestic investors. Their yield requirements are lower, so they can afford to pay more. For example, take a hypothetical development deal. A U.S. group might be seeking a 20% internal rate of return, IRR, while a foreign group might be happy with a 12% IRR. Similarly, for a cash-flowing deal, domestic investors could be looking for a 6 or 7% cash return, while overseas investors would settle for something in the range of 4%, a material difference. Moving to the United States. Another driver of CRE interest in the United States is the fact that deploying large amounts of capital in the country, including through CRE investments, opens up a shortcut toward legal residency and or citizenship. The EB-5 Immigrant Investor Program allows investors who acquire or buy shares in certain U.S. assets with a value between $900,000 and $1.8 million to get on the fast track for citizenship. That said, many foreign investors are institutional or high net worth individuals who already have their visas set up or for whom immigration to the U.S. is not a concern. Working with local partners. In many cases, foreign investors also like to pair up with a U.S. partner to both reduce their sweat equity and to help get the lay of the land. This takes the form of teaming up through a JV development partnership. Working with foreign investors, local sponsors can afford to pay higher prices for real estate assets than if they were working with U.S. investors. Their promotions also can be higher because, as mentioned earlier, foreign investors typically don't need the same returns U.S. investors require. Local sponsors can make out quite well in this scenario because although deal-level projected profits may be lower as a result of paying higher prices for assets, their promotes are larger and the returns they have to pay the foreign investors lower. So overall, the two balance out and the local sponsor can get into deals they may not otherwise have been able to compete on. Adding to the economic attractions of working with foreign investors relative to U.S. institutions and private equity shops, they also tend to be very hands-off. Typically, you can see anywhere from 9 to 13 hours in time difference between sponsor and their investors, which, from a strictly practical perspective, makes it harder for overseas investors to be hands-on. They're relying heavily on their local partner to execute the business plan, manage the property, etc. That's why more than 50% of their underwriting is underwriting their local partner, because they can't be hands-on and they can't be Big Brother watching over and directing them daily. What countries invest in U.S. commercial real estate? Asia. The makeup of foreign investors in the CRE sector varies over time, but in the first 2/3 years of the Trump administration, many investors from Asia have been the prime players. In particular, Japan, South Korea, and Singapore have been actively replacing investors from mainland China whose investments in U.S. real estate have waned due to geopolitical issues there. Japanese, South Korean, and Singaporean investors have become very active. They want to do bigger deals, and almost any deals they want to figure out how to make it work. That's probably the most active group of foreign investors in the US at the beginning of 2020. Middle East. Often when Middle East capital is mentioned, Abu Dhabi, Dubai, and Kuwait are mentioned, but while these countries do have a presence, the real money from the Middle East is coming in from Saudi Arabia. A lot of the time they're coming in privately, so to speak, more discreetly, without any big announcements that they've made investments in certain deals. But the money's in Saudi Arabia for the Middle East. That's who all the big deals are getting done with. Asia, Middle Eastern, and Saudi money in particular is the biggest single foreign capital flow into US CRE. Europe. Europe is third on the list in terms of activity in the US. There's a lot of activity from some of the large pension funds in Europe, mainly from the Nordic region. They are typically more focused on buying or investing in A-class assets like office buildings in downtown locations or industrial logistics facilities. They're looking for deals that don't have a lot of risks, whereas Asian and Middle Eastern investors have different risk tolerance compared to Northern Europeans and are more likely to invest in redevelopment deals. What areas do they invest in? In the commercial real estate space, foreign investors work with both debt and equity investments. Singapore, South Korean, and Japanese investors tend to prefer to invest in equity deals, though South Korean investors in particular focus heavily on debt, particularly first position and mezzanine debt. South Korean investors also like development deals where they can provide the debt. On the equity side, all Asian investors will look at buying existing projects versus the ground up, and on construction deals, they will invest in first mortgages and mezzanine loans on anything ranging from hotels to offices and multifamily projects. Value add. Value add is another major focus for international investors. For instance, a redevelopment deal for a Class B building downtown that has the potential to become a Class A building with the right refurbishing. In a similar manner to mezzanine loans, foreign investors can and will take lower returns for redevelopment or value-add projects, which works out well for them, since they are comparing it to returns back home, while local partners gain a greater degree of control and lower interest rates. Asset classes preferred by overseas investors. For foreign investors, there's always an interest in Class A and Class B office space value. There's a familiarity with these types of assets in investors' home countries, and underwriting is often run on similar models there as here. Multifamily is also an interesting asset class to them as well. Interestingly, however, some overseas investors aren't as knowledgeable about residential rental models as they have far fewer similar developments in their own countries. Some will report that while people tend to own their condos and maybe own a few more units that they rent out on an individual basis, owning large residential apartment buildings in their entirety for rent is less common. Conclusion. Despite challenges and setbacks, particularly those caused by the trade war with China, the US CRE market remains a bastion of strength. Investors around the world flock to American commercial real estate assets due to their growth potential, relative stability, and in some cases, the personal benefits one may acquire as a result of ownership of American CRE assets, namely the ability to live and work in the United States. These characteristics, alongside global economic woes, should lead to a continuation of or even growth in the total amount of foreign capital invested in the US commercial real estate market. If you found this video mind-boggling as we did, make sure to like, subscribe, and drop a comment below with your thoughts. Stay tuned for more shocking stories and unraveling mysteries. Don't miss out.